Welcome back to Launch Window Research. Today I'm joined by Kenny, who's going to help break down Rocket Lab's Q4 earning results. We're going to try and use these results to answer a bunch of very important questions about Rocket Lab's future. Most importantly, do they have enough money to build Neutron? I hope you enjoy.
Hey, what's up, everybody? Kenny here, obviously from Redcliffe Research. I'll be helping you break down these numbers. Essentially, I took a look at them, I stared at them, and interested in giving you the results here.
Yes, Kenny is filling in with his financial expertise that I lack, the decades of looking at these types of earnings. So we're really happy to have you here, Kenny. Let's get into it.
Awesome. So we're going to kind of breeze through this because this is pre-earnings, and then we'll kind of focus in on what the earnings said about our kind of assumptions. But the cool thing is we are looking at the assumptions. So right now we're looking at the dates between 2019 and 2021. That's indeed because obviously Rocket Lab was founded in about 2006. It went through about, I think, 5 rounds of funding. So I think they're on Series E before they went and IPO'd. If you're confused about that, we'll kind of explain that at the end, but just kind of keep a bookmark on that. Essentially what we have here is the SEC Edgar filings, which only really goes back to 2019 because as a private company, they don't have to disclose how much money they made. And so what we did is we kind of broke down like what they have and what they've showcased in terms of, what's public right now. So 23 launches, which produced $34 million in revenues over 9 months. So obviously 9 months, 3 quarters. So 4 over 3 times 34 equals $45 million a year. And we're using that as a base approximation. Obviously, there's going to be a ton of variance here and a ton of speculation and a ton of intangible assets. But we're just focused in on figuring out the base numbers. And this is important because if the base numbers look good, then geez, on a speculative stock, this is going to be amazing. But we'll talk about that kind of in the end. But assume that there's 16 launches that were executed in the last year. That means that for each launch, it's worth about $3 million. So I'm assuming here that these rockets are not fully loaded with satellites. And Nathan, please correct me if I'm wrong, but is that assumption okay?
No, totally. A whole lot of these rockets get off the pad not completely loaded with satellites. And that's part of the reason that this dollar per kilogram metric that so many analysts like to use isn't really accurate. And what matters at the end of the day is the ultimate final cost of what it takes to get the rocket off the pad, no matter whether or not it's loaded. And that's the appeal of these smaller launches, even though on a dollar per kilogram basis, they don't look as good as, say, like Starship or Falcon 9.
Perfect. So I'm not completely bonkers on that. Great. And this is why I think it's really good when you have somebody on the tech side and understands the tech solution, and understands the tech advantage of companies, and then also kind of somebody who's looking at the financials. So, on this next slide, really, we go over 2 years. There's been 109 satellites sent to space. Assume that 3/4 of those were sent over the last year. That makes 80 satellites. That gives the firm about $500K. Again, I'm glossing over these slides, but you can kind of take a look at kind of my approximation and kind of my hypothesis here. But total cost here per year per satellite, that's 58 over 80, $725K. I'm going to keep continuing. Again, I'm going to gloss over this because I really want to get to earnings. But again, here's some more assumptions. But the key thing here is I'm assuming a discount rate of 10%, which gives us a market cap of about $2 to $3 billion, which is currently about half the value of Rocket Lab. Now, before you go screaming, the sky is falling, just hold on and stand by. We're going to talk about more of it and talk about intangible assets, which is very, very important to our Redcliffe and launch window research model. Okay, I'm assuming a 10% discount rate, and that's because obviously with the rate of inflation, just thinking about how other kind of asset classes interact macro-wise right now, I would not be putting my money in a high speculative stock or name like this outside of just reasons for ethics. If I'm saying just a normal, typical investor, if you don't assume at least a 10% discount rate for risk. And if you don't know what that means, it's essentially saying, hey, how much is your money worth? And what is the weighted average cost of capital for you as you discount into future years? So 5 years into the future, for instance. So here's a typical EBITDA exit model that we're looking at. The thing that you'll look at and the thing that I really need you to see here is that there's a 68% growth on December 21st. And spoiler alert right now, they beat that. Okay, so the forecast we had here is 68%. The key thing here, if you look at the kind of generated forecast, this is based on a smoothing score based on all of the other analysts in the kind of space that are really steering at this, and then I've put in some assumptions and calculations of our own. We get 333% growth in December of 22. So that's massive. We're asking for massive growth this year. Just be very clear about that. But then after that, we hit like a terminal rate where it kind of normalizes and we get to about a 50% rate.
Rocket Lab just brought on LC1B, so their launch site in New Zealand just got a second pad, and that doubles their launch capacity. So we're going to see massive growth as that pad comes online, and then of course it's going to normalize. Once you get to a large rocket company, you can't see massive growth multiples year after year after year. But then we'll see, a second large jump when Neutron comes online. So it's going to be incremental, step by step, over several years, but the growth is there, and that's exactly what we're seeing in these projections.
All right, so as we look at this slide here, this is showing kind of a distribution or kind of just some models based on the discount rate. So typically, or what the smoothing score would suggest, or the analysts in Wall Street are actually modeling this with a very low risk tolerance, which is kind of bonkers to me, but they're looking at 7%, 6.5%, and 6% as a high. So they're not asking for much return, which is kind of crazy based on the beta of the stock. So the beta of the stock is how risky the stock is relative to the market and how much it moves relative to the market, and something that we call implied volatility. That side, if we kind of take a look at the selected discount rate, the one that I think is most fair is 10%. So 10% being the fact that, so if you look historically, the S&P averages around 7.5 to 8.5% over time. And if you look at that rate, we have to get a premium for the risk that we're taking, right? So that premium equals about 10%. And because of that, as you can see right now, the implied fair value here is $5.05, which equals a negative 46.6% downside. So again, before you get all gloom and doom, let me go on to our final thoughts. So final thoughts here is that we'll need to see a marked improvement of the Neutron, or the stock will actually
the Neutron on this slide.
Oh, shit.
I think in the research we give, so Rocket Lab's rocket is Neutron, not Neutron. We'll just keep moving.
No. We'll fix this slide before it gets to him. I just saved it.
Just leave it in. Leave all of this in, Giovanni.
All right.
All right, we'll keep going.
So final thoughts. Basically, we're gonna need to see a marked improvement in the Neutron rocket, or the stock will actually be valued what it's actually worth. But that said, again, some of these intangible assets that Redcliffe Research takes very, very seriously. A couple things, right? One is network score. Network score is very, very invaluable, and I think a lot of folks have done correlation coefficients and modeling that suggest that it is a real thing. So we definitely take those premiums into consideration, which definitely kind of accelerates, I guess, the price and the growth of the company. Meaning the price of Rocket Lab right now at $9 a share. Think about that, right? I think about $9 a share. I didn't check pre-close or whatever, but is valued at what it's valued. And there are reasons for that. And those reasons are intangible assets. So there is a premium that you're paying for the company, and not so dissimilar from Tesla, where you're saying, okay, Tesla is going to be the leader, is going to change the market. And because of that, you assign them a premium. That premium is definitely modeled by us, not showcased here, but it's definitely a part of our intangible assets. All right, so what you're looking here is basically an options long call simulator, and this is from OptionStrat if you want to play around yourself. But the reason I pull this up and the reason I'm showing you this is because of implied volatility. So 91% implied volatility for long-term options is pretty serious when it comes to how much the market is risking in terms of how high it could go or how low it could go. So basically, I'm not saying this is a lottery ticket, because the thing that I want to really impress upon you is we've done the tech analysis, we've done the fundamental due diligence, they have enough free cash flow. And that's kind of the next thing that I want to talk about.
But Kenny, the question that everyone's been asking, what about FCF?
Yeah, I knew you were going to ask
What
that.
is
And that's why this slide is right here. So free cash flow, or what we would consider operating runway, especially given the R&D spend and the CapEx, or capital expenditures, for a company like this. So right now you're looking at 2 years. I think the first year was 45 and the second year was 53. So the average of 48.5 million in spend. Obviously we only have 2 years, so that's really hard to constrain or kind of sample. But given that, the average is $48.5 million a year. So current assets against current liabilities, $76.74 million in current liabilities, which is actually increasing based on the new earnings. But anyways, current ratio of 11.1x. What does that mean? That means that they have about 11 years of runway before they go bankrupt and need to raise money. But even if they did, which 11 is really bonkers, it's really, really... So typically, if you're not kind of familiar, a good kind of benchmark, if you just have one, you're probably fine. If you have two or three, you're very, very good. That's very, very healthy. If you have more than that, you're looking to acquire or you're looking to spend on R&D very significantly, or you're Apple and you have basically a bond portfolio that's the size of, I don't know, Moscow. You get my point.
Yeah, so this is exactly what we would like to see if you're trying to develop a partially reusable rocket, unlike anything ever built before. And that's exactly what we're seeing. Rocket Lab does have the money to embark on a project this big. And for reference, I think they have around, like, this is in a future slide, but around 700 million. The Falcon 9 took about 300 million to develop. So if they can even just develop this for as much as the Falcon 9, they're more than fine. And also, it's probably going to take less because, one, they get to learn from the lessons of the Falcon 9, and Rocket Lab is a far more experienced company than SpaceX was when they built their original reusable rocket. So there's no reason to believe it'll take any more than 300 million, and they have 700. So we're good financially.
So essentially, exactly what Nathan was saying, we have plenty of runway. But just know that even if we did run out of 11 years of capital, there are three ways in which we could get more money. And I know this because we did this for a stock called Jamia, which we're very bullish on in Red Cliff Research. But essentially, to increase that runway, you have three options. One is increase revenues. That's the best option, which, by the way, based on this new earnings call, we have been doing. Second is to dilute shares. Obviously, this destroys shareholder value. That's not optimal, but it's also doable, right? If you get in a situation where you have to or you need to acquire something, you can do it. But the third, in the most kind of obvious solution for companies of this size at this scale or this stage, is probably borrow money. But it's currently expensive based on just the inflation data and kind of where we're at in terms of the Fed. So that said, that's probably not the premium optimal solution. I'm going to gloss over this really quickly, but I just want to show you that when it comes to borrowing money, just realize that, again, Rocket Lab went through a series of funding rounds. But as you can see here, here's the top 5 kind of companies that finance them. But look at the top one, United States Space Force. So the United States Space Force has a vested interest in Rocket Lab's success. Will they bail them out? Probably not. You probably have to go down to Vector Capital or BlackRock, but obviously two very big companies that, given how much equity they have in the company, may or may not want to step in and make sure that, Rocket Lab is still a profitable company. Any thoughts on that?
Yeah, just like as a last case emergency, Rocket Lab, as based on these numbers, will not need any bailing out anytime soon. So we're not trying to scare you, but I think the majority of the Ukrainian population doesn't know what's going on in their own country just because they lack the satellite coverage, be up to date on news. And that's something that could very well happen to other countries. It could very well happen to us if things begin to escalate even further. So I think a lot of people working in defense all around the world are seeing the value of being able to redeploy satellites when they get knocked out rapidly. And, everyone talks about Astra being the go-to for that, but Rocket Lab is more than capable of that as well. So when it comes to providing, security and peace of mind to citizens of your country, this service is extremely valuable, and we're going to see people start to realize that a whole lot more.
You want to talk about a real use case. So I have a friend that I served with in Iraq in 2004, but he's Ukrainian American, but essentially his niece is stuck in Lviv, and they're trying to get her out of the Ukraine because, 6-year-old in a situation like that, best to get her out, especially being that she's half Ukrainian, half American as well. So one of the things that, I obviously kind of told them, and kind of like when it comes to packages like that, or communication packages, and this has a lot to do with satellite and satellite communications, is, two kind of loadouts that I recommended. And one was obviously satellite communications. So basically being able to, at all times, really communicate. And there are very, very good solutions, but that's obviously only because these satellites are flying and live. And we have superiority when it comes to that, right? So primacy. The second piece is, yeah, there's a lot of even cheaper solutions when it comes to even just text messages through satellites, right? There's very, very cheap $20 a month solutions. And so, being able to have that in a situation like this for the Ukrainian people, I think it's a very, very powerful thing. Well, we know it's a powerful thing. So, I'm just saying that I feel like, I'm going to get a little preachy here, but right now it's like Russia against the world, literally, and the world is coming together every way possible to sanction and to kind of do these things. And companies like this are very important because of that.
Yeah, we know the value of these companies, but it might be around the time where the rest of the world is really realizing it just because it's so real at this point in time. All right, so moving into the Q4 earnings call, here was one of their slides from the call. This is showing Rocket Lab's current capabilities, and we have a 6-step end-to-end solution in this company. And this really, demonstrates in a single slide exactly what Rocket Lab means when they say that they're an end-to-end space company. We can also see their brand new logo here. But you have satellite design and manufacture, components, flight software, launch sites, launch services, and then on-orbit operations. So from the very beginning of conceptualizing, building your satellite, to developing it, to rolling it out to the pad, to launching it, to even managing it once it's already in orbit, is all manageable by Rocket Lab. This is vertical integration on a level even higher than SpaceX. SpaceX vertically integrates themselves on a manufacturing basis, but this is vertical integration on a servicing basis. Because really, when you think about it, Rocket Lab isn't a space company. Ideally, it's a data company. Most of these space companies are people who buy, services from these space companies. They don't care about the satellites. They care about the data the satellite provides. So if you're able to take all of that and put it in-house, Rocket Lab knows this. That is where you get the highest possible margins and provide the best possible service, and that's exactly what they're building right here. Kenny, do you have anything to add to this slide?
Yeah, that's right. Actually, one of my data analytics companies that I co-founded uses satellite imagery as an additional kind of alternative data source when it comes to what we call surveillance as a service. So yeah, definitely. Okay, so I wanted to pull in this slide, and I typically don't use the slide deck. I typically just go straight to the balance sheet breakdown. But one of the things that I just wanted to show you again, 24 million from Space Force awarded. That is a big deal. I'm sure that the money gets allocated across the space industry and across the private sector, but 24 million is not unsubstantial, especially given how much we know that Rocket Lab needs to run. Previous year, remember, 50 million, right? 48.5 million. This is half of that. So, I mean, one contract is essentially sustaining that. Of course, we have to amortize over the life of the contract and stuff like that, but you get my point.
So another thing we can see on this next slide is that their backlog grew, and it didn't just grow, it multiplied several times over. So in Q3 2021, it was at 183 million. Today it rests at 545 million. And this is, again, just with Electron. This isn't even counting the types of customers that they're going to get once they have a rocket capable of 20 times the payload, and only, having to launch for maybe twice the price. The demand, we're starting to hit that curve. We've been talking about this curve for years. Everyone's been talking about it, but we're really seeing it with the backlog growing almost by a factor of 3 in less than half a year.
Yeah, that's a great problem to have. This is the financial outlook. There's a lot here to dissect and kind of uncover, but the biggest thing I want to draw your attention to is the expected GAAP and non-GAAP. So if you don't know the difference, one is essentially like the official audit, and the second one is like, hey, there's some nuance to how we do our books, and because of that, there might be some trailing indicators or some contracts that are already set, but we're not counting. Those are non-GAAP. But in both cases, in both circumstances, they're both growing, right? So expenses are growing. That's not terrible, though. We do understand that we do want to see growth. I mean, I know that growing that piece is a weird proxy for growth, right? And you're asking, Kenny, why do we care about liabilities? We do because, these liabilities are offset by the actual revenue gain, which we proved in the previous slide. For those who don't understand what the difference between GAAP and non-GAAP kind of accounting is GAAP is essentially the by the book way that the SEC tells you need to account for things, right? I'm going to use Roblox as an example. So Roblox, when they're doing the GAAP accounting, they need to take into consideration service and they need to take into consideration refunds, right? But essentially, there's a clause when it comes to the metaverse or the Roblox kind of universe that says that they don't owe any customer service and they don't actually have to provide any of that. So because of that, they're non-GAAP, so they're non-official accounting principles would suggest that, hey, they don't have to account for that. And it's very, very true. They don't, and they don't need to. So that number looks monumentally larger when it comes to revenues because they don't have to account for that. So there's nuance in every industry. And for somebody like Rocket Labs, that nuance could be a lot of different things. But I'm just suggesting that even in both cases, you know, the GAAP versus the non-GAAP, there's going to be some kind of variance, but there's really not that much here, which is really cool. So I'm just going to go through this really quickly, and you're like, why would I go through this really quickly? Because I'm going to show you what this really breaks down to. But essentially, the full year here represents 77%. Look at the first bullet, representing 77% growth. So that's a beat. Q4 2021 revenue above high-end prior guidance at 27.5. So on the quarter, they beat as well. And if you're asking me like, hey, is this surprise? I don't know that it's enough to be surprised, but it's a beat, and a beat nonetheless, which is really important when it comes to companies like this. Okay, so here's the important thing, and the thing that we really, really want to focus in on. First quarter guidance is always very, very, very important, because if you guide very weakly, what happens is, you know, that doesn't breed confidence amongst the investors, right, or the investor pool, especially given how much retail inflows there are in a company like this. But revenue is expected to range between 42 to 47 million, and the GAAP margins will increase 17% and 30% respectively. So we're still forecasting growth, which is still very, very good. So we don't have enough historical data to know whether or not that they're very let's just break it down very simply, very humble in their kind of forecast, or if they kind of get very aggressive. I don't know for sure or for certain. So for instance, a company like AMD is very, very humble when it comes to forecasting growth, which is why I'm very bullish on a company like that. But here, we just don't know. So I'm going to take them at face value. But if we do take them at face value, indeed, there's still growth here, which is very, very important.
Yeah, so of course, you know, the space industry is sort of infamous for delays. I think the last space project that was completed on time was the Apollo program, and that's because NASA had 5% of the federal budget and they were fighting Soviets. But that is something to consider. I do think Rocket Lab is at least more conservative than Astra with their 300 launches by 2025. So yeah, I think they're good for at least like 80% of this.
So slide 18 is just a graphic showing growth. So as you can see here, Q3 to Q4, and then 20 against 21, growth in both situations. Just showing you this to show you the visualization in case you're a visual learner. All right, so this is the big deal and kind of the breakdown. Like, of course, you know, coming into this, we already had our kind of hypothesis, and that's a good thing. You want to kind of have a read on where you think the company will grow or how it's going to grow. And we indeed forecast a 68.5%, and that's in line with other analysts. We didn't really depart very much from that. Given the tech solution, I think our actual number is around 70%, right? Very, very mild kind of premium there. That said, right now, as you can see, 77% year over year growth, which tells me that they're beating analyst estimates. They're beating our estimates, which is really what matters to us. So 77% growth, definitely hitting the mark. Again, the thing that you need to watch, though, is this year has to be and should be big. All analysts are presuming it and assuming it. Not just us. So we're looking for like a 300% growth. What does that mean? That means that's already actually baked into the stock price. So if we don't see 300% this year, that could get the stock back to a level where fundamentally it should be valued at about $5.85 according to this fair market value. Not trying to scare anybody, but I'm just suggesting that they are in a growth phase. And so we just have to be cognizant of that.
Yes, growth is the expectation. They're not going to be surprising anybody with the growth. But we have them bring on LC-1B, basically doubling their launch capacity. They're expanding their US operations. They're going to catch their first Electron and begin to figure out how exactly to refurbish it and put it back on the pad to really drive those costs down. And we're seeing Neutron's Archimedes engine get hot fired for the first time. So this is a massive year. And if there's any year for a company like this to see 300% growth, it is 2022. Right here, we'll just wrap up showing you guys their research and development versus general administration spending. We're seeing both increase aggressively, which is what we want to see. As a company grows, you naturally expect their expenses to increase. And we're going to see the R&D skyrocket very, very aggressively as they develop partially reusable launch system, which will be capable of human spaceflight. They're not developing a capsule quite yet, but they're making sure that when they build Neutron, it's already prepared to take humans so that they don't have to recertify the rocket in the future. Because again, this company has a long-term vision of enabling human spaceflight and our exploration of the solar system and the expansion of consciousness. So nothing quite like that happens overnight, and things like this do cost money. But again, as we've shown, they have the money, they're ready to pour in all that money, and it's going to be a very, very exciting few years. So, Kenny, any closing thoughts before we wrap
Yeah,
this up?
closing thoughts. There are some kind of bearish looking numbers here, but just realize that when I look at this from this lens, I do want to be very practical, very pragmatic, and very kind of non-biased, right? But that said, I'm very bullish on this company because indeed, Launch Window Research has done great due diligence, and we know that they have the tech advantage, and that's a non-tangible kind of thing that we can bake into the premium of the stock. The second piece is just know, based on the implied volatility, it's going to be a bumpy ride. So if you can't stomach that, just make sure your position size is according to how much risk you're willing to take. And a good kind of barometer for that, or kind of a metric for that, is take that position size or how much money you have in the stock right now and say, okay, based on this implied volatility, what kind of downturn could I see? And then if that number is too much for you to swallow, then thin out your position size is what I'd say. I'm not a financial advisor, but that just works for me.
All right, sounds good. All right, well, good luck investing and trading Rocket Lab stock, and we'll see you guys in the next video.
Thanks, everybody. Bye.